Little or no money down. It sounds almost too good to be true, but it's a strategy that I've been using for years. Whether you're just starting out your investment journey or you're looking to expand your portfolio, understanding how to leverage OPM or other people's money is a game changer. So if you're curious about how this works and you want to start building wealth through real estate, do me a favor, stick around because I'm going to deep dive into these strategies today. Former mayor and I retired from the military early using rental property. In today's video, I'm going to explore how you can start investing in rental properties without needing a large down payment. The idea here that you need tens of thousands of dollars sitting in your bank account to start investing in real estate is a common misconception, but it's just not true. The belief keeps a lot of aspiring investors on the sidelines thinking that real estate investing is only for wealthy or those who have been saving for years. In reality, I got into it with nothing. And there are numerous strategies that allow you to get started with very little upfront capital. And by the end of this video, I'm going to let you know exactly how to get started with a minimal down payment or even no money down, and exactly the 4 reasons that I got started. But before we jump into specifics, let's set the stage. Why is real estate such an effective way to build your wealth? Well, for centuries, real estate has been one of the most powerful wealth building tools. It offers multiple streams of income from rental cash flow to property appreciation. And it comes with a lot of tax advantages. And when you do it right, real estate investing allows you to create passive income, build equity, and achieve long-term financial freedom. So today, let's explore these strategies for acquiring rental properties with little to no money down, including things like seller financing, partnerships, and government programs. We're also going to cover other creative financing options like lease options, hard money loans, and house hacking. By the end of this video, I hope you're going to be ready to take your first steps toward building a real estate portfolio without needing a huge pile of cash. Let's talk about the myths. One of the biggest misconceptions about real estate investing is that you need a large amount of money saved up for your down payment. This is so widespread that it discourages a lot of people from even trying. They assume that only people with substantial savings or high incomes can invest, but it's just not right. I mean, the traditional 20% down payment, it's not always a requirement for all real estate transactions. And yeah, conventional loans require this a lot of times. There are other options that require a lot less or sometimes nothing at all. What if I told you that there are investors who have acquired multiple properties, me being one of them, without ever putting a dollar down or even more than a few $1,000s or even less in some cases? It's possible, and I'm going to show you how. So I'm going to cover some real life examples here of investors and students of mine who started with almost nothing and built their thriving real estate portfolio. And if they can do it, so can you. And the key here is to understand and utilize creative financing strategies that allow you to leverage other people's money to grow your portfolio. So let's talk about one of the most powerful strategies. Pace Morby is a big name, and he talks about seller financing. And in a seller financing deal, the seller of the property acts as the bank. So instead of going through a traditional lender, the buyer and the seller agree to terms, and the buyer makes payments directly to the seller. This is a win-win situation. The seller gets to sell their property and earn interest on the loan, while the buyer can often negotiate more favorable terms, including little to no money down. But this is how it works. Seller financing is particularly common in situations where the seller owns the property outright and doesn't need to pay off a mortgage. This allows the seller to be a bit more flexible in structuring the deal. So instead of receiving a lump sum from the sale, the seller receives regular monthly payments, just like a bank would if they were issuing a mortgage. So I'm just going to throw out an example using round numbers. Let's say you're interested in purchasing a $200,000 rental property. The seller agrees to finance the deal, and you negotiate a payment plan where you pay $1,500 a month for the next 10 years with a balloon payment at the end. The seller might ask for a small down payment, say 5% or even less, which could be $10,000 in this case. Compared to the $40,000 you'd need with a conventional loan, compare that to the 20% you would need for a traditional mortgage. And here's some of the benefits. One is a lower down payment. One of the biggest advantages of seller financing is the ability to negotiate a lower down payment or no payment at all. Sellers who are motivated to sell quickly or want to avoid the complexities of dealing with a bank might be open to flexible terms. Flexible terms is the next key here. Unlike traditional lenders, sellers are more willing to negotiate interest rate, the loan term, and the repayment schedule. And this flexibility can make it easier for you to acquire the property, even though you don't meet stringent requirements of a traditional mortgage. You can close faster. So without the need to wait for a mortgage approval, seller finance deals can often close much faster. This can be especially beneficial in this competitive market where other buyers might be waiting for weeks for loan approval. All right, let's talk about Sarah. She's awesome. She's a young investor who wanted to purchase her first rental property but didn't have much saved up. She found a motivated seller who owned a quad. That's a 4-unit building. He owned it free and clear and was willing to offer her seller finance. He asked for $5,000 down and agreed to finance the remaining $195,000 at 5% interest over 10 years. The monthly payment was $1,550. She collected $3,000 in rent. That was the long-term tenants, and she went short-term. After covering her mortgage, taxes, and insurance, she was left with $500 in positive cash flow each month. She's now a landlord, minimal upfront investment, and she doesn't have to pay rent anymore. This strategy allowed Sarah to enter the real estate market without needing a large down payment. After a few years of making payments, she's built up enough equity in the property where she can use the refinance and purchase her next investment. Let's talk about partnerships. It's another powerful way to invest in rental property properties with no money down. In a typical real estate partnership, one partner provides the capital while the other provides the day-to-day management of the property. This allows individuals who lack the necessary funds to invest in real estate by leveraging the resources of a partner. And there are a bunch of different types of partnerships, and I'm going to go over just a few. This is how I started. Capital partner versus sweat equity. So in this arrangement, the partner provides a down payment and financing. That's the capital partner, while the other partner contributes their time, their experience, and their effort in managing the property. That's the sweat equity part. The profits are split based on the contribution of each partner, and that's predetermined in your operating agreement. Your joint venture is two or more investors where they pool their resources to purchase and manage a property together, where each partner contributes something, capital, expertise, or both, and they share the profits accordingly. Last is the big deal, syndication. Real estate syndications involve multiple investors pooling their money to buy larger properties like apartment buildings or commercial property. A sponsor or syndicator manages the investment while the investor provides the capital. Syndications can be a great way to invest in a large-scale property without needing a lot of capital up front. Partnerships offer a lot of advantages to investors who may not have their own capital. First, you can access more capital. By partnering with someone who has the financial resources, you can invest in properties that you might not be able to afford on your own. You're dispersing your risk. Investing with a partner allows you to spread the risk. If the property doesn't perform, you're not solely responsible for the financial loss. And you have complementary skills. So in a partnership, each person can bring different strengths to the table. For example, one might have experience in property management, while the other has a background in finance or construction, and the other one can put your website together. Okay, tell me if you've heard this one before. Bud and Matt are two friends who both wanted to invest in real estate, but we had different challenges. Matt had money in savings, but no time to manage a rental property because he works all the time. Bud, on the other hand, has experience managing rental properties, is in the military, but lacks the capital to make the down payment. They decided to partner up. Matt provided the down payment. Bud managed the rehab and the day-to-day operations of the property. Purchased a duplex for $120,000, and the rental income not only covers the mortgage, but it generates a $700 a month profit. Over the next couple of years, the property appreciated in value. Matt and Bud decided to refinance, pull out $30K of the equity, and purchase another property. So it's a single family, put Section 8 in it. It's in Trenton, New Jersey. Together, they were able to grow the portfolio without either of us, it's me, needing to come up with all the money and manage everything alone. So finding the right partner is key to a successful partnership. And here are a few tips for finding potential partners. You want like-minded individuals, so network with other investors. Attend your real estate meetups, join online forums, become a member of your local RIA. These are great places to meet potential partners who share your goals. Don't forget, you may know enough people that are interested in investing, so leverage your existing network. Don't overlook your existing connection. Your friends, your family, your colleagues might be interested in investing in real estate, but don't have the time or the expertise. So partnering with someone you already know and trust can make the process smoother. I met Matt in an upscale bar and grill at a Flyers game, and met my other partner, Zach, at a meetup my friend was running in Pittsburgh. Be clear about expectations. This is where it gets tricky. So before entering in a partnership, it's essential to have a clear agreement about a person's responsibilities, profit sharing, and exit strategy. This will help you avoid conflicts and ensure that everyone's on the same page. Think of it as kind of like a prenup. There are several government programs that are designed to help first-time homebuyers and investors get into the market with minimal upfront costs. Programs offer low down payment options, making them an excellent choice for investors who want to get started with little money down. First is FHA loans. These are great. Federal Housing Administration offers loans that require as little as 3.5% down. While FHA loans are typically used by first-time homebuyers, they can also be used to purchase multifamily properties up to and including 4 units, provided the buyer lives in one of the units. This strategy, which I talk about all the time, is house hack. It allows you to live in the one unit while renting out to others to cover the mortgage. So imagine you're buying a fourplex for $400,000 using an FHA loan. You put 3.5% down. You need $14,000 up front plus closing costs. You live in one unit. You rent out the other 3. If the combined rent from the 3 units covers your mortgage, you're living rent free and you're building equity in the property. Next, near and dear to my heart, these are VA loans, Veterans Affairs loans. They're available to eligible veterans and active duty military members and allow for 0% down payment. Like FHA loans, VA loans can be used to purchase multifamily properties up to 4 units, provided the buyer lives in one of the units. If you want to know more about that, here's an example. Ruben was living in an apartment building, $1,200 a month in rent. He's a veteran. Got him to use his VA loan to buy a fourplex with no money down. He lives in the one unit, rents out the others, generates enough rental income to cover his mortgage, and he makes $700 per month. That's a $1,900 swing. Over time, he buys another property, enjoying the benefits of homeownership without having to pay rent or mortgage out of pocket. By the way, bought the second one using an FHA loan. United States Department of Agriculture, the USDA, offers loans with no money down for properties in designated rural areas. It doesn't mean farmland. So while they're typically used for primary residences, they can be an excellent option for investors who want to purchase properties in more rural areas with a strong demand. So let's say you want to invest in a rental property, but you live in a rural area. Well, you find a $250,000 USDA eligible property and use a USDA loan to purchase it with no money down. You rent out the property and use the rental income to cover the mortgage payment. Over time, property appreciates, you're able to build equity without using a large upfront investment. So I talked about seller financing a little bit ago, but in addition to that, in addition to partnerships and government programs, there are other creative financing strategies that can help you invest in rental properties with little to no money down. So let's talk about those for a second. Lease options. A lease option allows you to lease a property with the option to purchase it at a later date. This strategy gives you control of the property and allows you to generate rental income without needing a large down payment. A portion of your monthly rent goes towards the eventual purchase of the payment. And if the landlord lets you, you can sublet that out and short-term rent it, mid-term rent it, or long-term rent it. You can even house hack it if you want. So Emily wanted to live in a rental property, but she didn't have enough for a down payment. She entered into a lease option agreement with the seller, agreeing to lease the property for 2 years with the option to purchase it at the end of the lease. So during the lease period, she rented out the property and used the rental income to save for the down payment. After 2 years, she exercised her option to purchase the property, using the equity she built through the lease payments as part of her down payment. Next is hard money loans. If you are interested in the BRRRR strategy, please set up a strategy session. Go to budevans.com. I love this stuff. Hey, do you need help running your business? I don't know what I would do without my executive assistant. Get outsourced solutions for every need by visiting Reba Global. Check them out now and get help for just about every aspect of your business today, from marketing through property management and even administrative virtual assistants. Check out Reba Global. The link is in the show notes. Hard money loans are short-term loans provided by private lenders. They are typically used to finance fix and flip properties. These loans are based on the value of the property rather than the borrower's credit, making them an attractive option for investors who want to buy the property, renovate the property, rent it out, refinance it, and take their money back out. Mark found a distressed property, $150,000, that he believes he can flip for $250,000. He got a hard money loan for the purchase of the renovation costs, understanding that the loan will be repaid at a maximum of 12 months. After the renovations were done, he sold the property for a profit and repaid the hard money loan, keeping the difference as his profit. But if he were to have rented it out, he could have made $2,800 a month in rent. Let's talk about house hacking. This is a strategy where you purchase a multifamily property, you live in one unit, and you rent out the others. Rental income from the other units covers your mortgage while you live rent-free and you build equity in the property. We already talked about one of my students, Ruben. Well, here's Chris. Chris bought a triplex. He used his FHA loan with 3.5% down. He lived in one unit. He rented out the other, so he's house hacking. The rental income from the other units covered his mortgage, so Chris is essentially living rent-free while building equity in the property. After a few years, guess what he did? He refinanced the property, he pulled out some equity, and he went out and he bought another multifamily property. So while investing in real estate, while investing in rental properties with little to no money down, this can be incredibly rewarding, but it's important to understand that there always are risks involved. These strategies require careful planning, negotiation, and a thorough understanding of the market. There are seller financing risks. While seller financing can be a great way to acquire property without a traditional mortgage, it comes with a higher interest rate and shorter loan terms. This can result in a higher monthly payment, which can strain your finances if the property doesn't generate the expected income. Partnership risks. Look, this is like a marriage. They can be highly rewarding, but they also come with potential challenges. There will be disagreements over responsibilities, over profit sharing, over management decisions, and it can strain relationships and jeopardize the investment's success. One capital call can destroy a relationship, so it's crucial to have a clear agreement in place and avoid those conflicts later. FHA and VA loans are great benefits, but they come with restrictions. For example, you'll need to live in one of the units for at least a year if you're using an FHA loan or a multifamily property. Failing to meet these requirements can result in penalties or loan denial. To mitigate the risks, it's really crucial to understand and conduct thorough due diligence before entering any deal. So let's talk about due diligence. We're going to take a high-level view here. Market research. You want to understand your local real estate market, your rental demand, your property values, and your economic trends. This is going to help you make an informed decision where and what you want to invest in. You're going to analyze properties, so evaluate the conditions, potential repair costs, and expected rental incomes. Make sure that your property is going to generate enough cash flow to cover your expenses and leave room for profit. Consult with professionals. Guys, have a real estate attorney, have a tax advisor, have a property inspector, GC, subs. Ensure all agreements, especially in partnerships and seller financing deals, are legally sound and financially viable. Investing in rental properties with little or no money down is not only possible, but it can be highly profitable if you do it right. By leveraging creative financing options, forming strategic partnerships, and taking advantage of government programs, you can start building a rental portfolio without needing a large upfront investment. Why did I start? Here's why. The long-term benefits of investing in real estate are substantial. I'm going to give you 4 reasons to start right now. 1, equity growth. You pay down the mortgage, your property appreciates in value, you build equity that can finance future investments. 2, cash flow. Rental properties can generate positive cash flow, providing you with a stream of income that can supplement or even replace your primary income. I'm going to break down appreciation right now because it's the increase of an asset's value over time due to market demand, inflation, property improvements, and in real estate, it happens as areas develop and through strategic upgrades. Appreciation boosts your net worth and creates opportunities for you to leverage that and the equity for future investments and refinance. Last one is tax advantages. Real estate investors can take advantages of a lot of different tax benefits, including deductions for mortgage interest, property taxes, and my favorite, depreciating the asset over time. So if you're ready to take the next step in your real estate investing journey, make sure to explore the other videos on the channel where I dive deeper into these strategies and provide more tips on how to achieve financial freedom through real estate. If you have any questions, jump over to buddevans.com, book a free strategy session, and until the next video, as always, aim high. Are you a veteran or first responder and you're ready to start your journey into financial freedom through real estate investing? Visit buddevans.com and sign up for a free strategy session today. Whether you're looking to wholesale or flip properties or do what I did and build a passive income portfolio, I'll help you create a customized plan to achieve your goals. Don't wait. Take action now and unlock your potential for success in real estate. Let's turn your dreams of financial freedom into reality. Head to buddevans.com and schedule your strategy session now.